for joining our training today on ACA reporting for 2018. What do you have to do now, and what's required to meet the requirements for ACA reporting? Before I turn over the time to our presenter, Holly Young, I did want to mention just briefly that so the training today is going to be a little bit more high level. Most of those who are participating in the training today are medical insurance brokers across the country. So we're going to focus a lot of the training on what do you need to know to be able to effectively guide and direct your clients. But we'll give you some detail. But if you're someone who's actually filling out the documents and you want a lot more detail, we're doing another training event on Monday, this coming Monday, at 11 a.m. Mountain Time. You're welcome to invite any of your clients to that one as well, and we will go into more detail there. So who has to do the training? Who has to complete the documents this year? So sometimes there's confusion. I had a medical insurance broker ask me the other day. He says our client had 50 or more about midway through last year in 2018. So they're an applicable large employer, right? And they have to do the reporting. My response to them and to you is no, they do not. It's based on the prior year. So we're reporting right now on 2018, but we have to look at, were they an applicable large employer? After you look at all of 2017, did they average 50 or more, or a full-time equivalent or full-time employees in 2017? If they did, then they're an applicable large employer and they have to do the reporting in 2018. And that's what we're reporting on right now, is we're reporting on 2018 for the due dates and everything that Holly would go over. The others who might need to do reporting is for anyone who has a self-funded or partially self-funded group. They have to do the B forms. So Holly's going to go into all of that. Holly Young is probably the most seasoned professional in the ACA reporting that I know. She's been with HR Service for a number of years and has worked extensively in the ACA reporting area on our behalf and in multiple other areas. Holly, I'm going to turn it over to you.
Thanks, Ken. Welcome, everyone. I hope everyone is having a nice afternoon. Moving through, we're going to go through our agenda very quickly about what we'll be talking about today. As you have questions, we have you on mute right now. So if you have questions, you can type your questions in and Ken will retrieve those and he'll give those to me as we go along. And we'll also open up for questions at the end of the presentation. So we're going to talk about the due dates. There was just recently an extension, which was nice. We're going to talk about the changes from the year before, different things to consider when doing the reporting, changes to the forms themselves, just a brief overview of the reporting requirements, and then I want to touch on late filing considerations and penalties. So let's get started. So this is what we know. So we're in 2019, but we are reporting for the calendar year of 2018. So regardless of what your plan year might be, the IRS requires that we report from January to December 2018. So some of you on non-calendar years may have to use some 2017 plan year information and then 2018 plan year information, depending on what your plan years are. So as far as, up till today, all employers must still comply with ACA requirements. Nothing has changed. I know that President Trump signed an executive order last year. But right now everything's on hold anyway, so it's just status quo. Employers are not relieved from any penalties, and those are the penalties for the pay or play penalties. So those are the penalties that would be assessed if the companies are not offering minimum value and minimum essential coverage employee to the employee and then to dependents. And there's two penalties. We're going to touch on that a little bit more later in the presentation. So those still unfortunately exist. There has been a good faith penalty relief that's been provided to us again this year, which is nice. So what that means is if you've messed up on birth dates or socials or, just administrative kind of things, maybe you accidentally used the wrong code or you missed a code, you're not going to be penalized for that mistake. Now, that doesn't mean that you might not get a letter because there were mistakes made, and so it looks like there wasn't an offer or, the IRS isn't understanding what you've offered, but for mistakes themselves on the form, those won't be penalized. I personally, I hope that just exists forever. The due dates were extended. They were actually extended in a fairly timely manner compared to last year. We didn't get notified till the end of December about the extension, and this time we got notified about a month earlier than last year. So here's when things are due to the employees. The 1095 form, so that would be B or C, whichever applies, needs to be postmarked to employees by March 4th or otherwise distributed to the employees by March 4th. In the IRS notice that was published, it does say on there that because the IRS has provided this extension, they will not provide an additional extension in getting the forms distributed to the employees. So March 4th is it. They did not provide extensions for when forms need to be postmarked to the IRS, so that stayed at February 28th if you're mailing in the forms to the IRS. And if you are e-filing, it must be done by April 1st. Please keep in mind that if you have 250 more forms that needs to be submitted to the IRS does require that those are e-filed. If there's less forms, you still can e-file, so it's sort of a built-in extension. For those with less than 250 forms, you can choose to e-file, and then you've got till April 1st. On those two dates, you may still file for an extension of 30 days by using Form 8809, and that could just be found on the IRS website. It's a pretty easy form to check the boxes, sign, and send it off. So changes to reporting, you probably most of you have been doing this long enough now. I know I've been doing it since 2015. The affordability changes every year. And so this year it went from 9.69% in 2017. It went to 9.56% for 2018. So that helps calculate, there's formulas to calculate affordability. And this really only kind of comes about when you're coding things on the 1095-C form if an employee happens to waive coverage. So there's rate of pay, and there's W-2 affordabilities, and then there's the federal poverty level, which also changes year to year, both because the FPL level changes, but then the calculation changes as well. So here's where we're at for 2018. We're at the $96.08. Now, again, if you have a non-calendar plan year, we do have to keep that in mind. I actually have a little chart that I gathered from Society of Human Resource Management, and it gives what the federal poverty levels were, the affordability percentage, and then what those amounts look like. So as long as employee-only coverage, the employee's portion of the premium is less than these amounts, regardless of whether or not that's what they chose, as long as that option is available and it's less than these figures, then it can be coded as what's considered a qualifying offer. It's less than FPL. And I will get into more specifics on Monday's call, but because there's tons of stuff that goes into coding. Just a really high level, there are considerations when you're reporting. This came out a couple years ago, actually. So flex credits generally can reduce that coverage premium unless the credits can be used to purchase non-health coverage or can be cashed out. So sometimes an employer says, okay, we're going to give you, $300 worth of flex credits, and you can use it to apply to the different benefits that you select. And if it's, if that includes your medical, dental, and vision, then you're fine. But if that employee comes back and says, well, I want to cash it out, then it can't reduce your premium. So opt-out payments generally increase the reported coverage unless it's conditioned on providing other coverage. So as long as the employee has option for other coverage, or if it was part of the collective bargaining agreement or another unconditional arrangement before December 16th of 2015. Wellness program incentives, for the most part, really generally are not considered. The one area that it is considered that affects the premium amount is if there's a tobacco cessation wellness difference in the rates. You'd need to report at the non-tobacco premium, and that is how that works.
Holly, I've had a question come in. Is it
absolutely.
Okay if I interrupt you for a question?
Sure.
I'm sorry.
Of course. Of course.
If an employee is making more than the federal poverty level, does the contribution limit go up respectively?
No. So the two don't really correlate. So it's not a matter of how much the employee makes when it comes to the FPL. Safe harbor affordability. It really truly is if your premium's $95 or there's a choice for an employee only premium at $95 a month, and whether that person makes $11 an hour or $8 an hour or $75,000 a year, it would be affordable for all of them. So when it comes to FPL, you don't even have to look at what the employee earns.
Thanks, Holly.
Does that make sense? Okay. So not very many changes to the forms. I do want to point out, it's a little bit of a frustration of mine. So apparently the AIR system that the IRS created to manage all these 1095 and 1094 forms is very, very picky. And I know we've had several clients that have had forms returned and requested that they be redone, even though nothing is wrong by all intents and purposes. Nothing's wrong with the form. So, so they've actually provided a notice about some specifics on how they want the font type and size of the font. So I've put that on here. I worked with our programmers so that we've got it on the forms that we produce. And the other thing is it has to be exactly the 8.5 by 11 PDF form that is found on the IRS website. It can't vary at all. So if you're scanning the form back and forth like to get its signatures, that can actually change the size and the IRS will reject it. And not only do they reject that form, they reject the whole submission. So so you may have one 1094C form that was wrong and they send everything back. So a little bit of a hassle. They've also, because so many employers, I guess, did not do the first, middle, and last name correctly. They've made it here, if you can see my cursor, they've split that up. They've tried to make it as clear as possible, both in the employee information and down here, if you're a self-funded group or level-funded group, there's a place for middle initial now as well. So they've really tried to differentiate that. And that's really about it as far as any changes that they've made to the forms. The 1095B forms are the same change. So they just have a space for the middle initial.
I'll let a couple more questions come in. Is
sure.
it okay to interrupt you again?
Yeah, absolutely. Interrupt away.
So first, the question was asked if we would be providing copies of this presentation, and yes, we will. We are recording this, and we will send this around to everyone. The next question is, if the employer calculates what the 9.56% of his lowest paid employee is and offers a plan that meets minimum value, so let's say $150 is below 9.56% of the lowest paid employee, is that considered a safe harbor?
Yes.
And if,
yes. In fact,
so,
that's
what code should they use?
So that sounds like it would be the rate of pay. So the rate of pay calculation is actually, because you don't get to use, like if they're a full-time employee, you would think that would be 160 hours roughly a month, but you don't get to use that. So it's actually 130 hours a month. So if you take your rate of pay of the lowest paid employee, multiply by 130, multiply 9.556%, that will give you the premium, the premium that you need to meet in order to be affordable under the rate of pay calculation, which is 2H. And so if anybody waives, you would be able to use that 2H code, and then that signifies to the IRS that you did everything you were supposed to do and it was affordable, so that you offered minimum value, minimum essential coverage, and it was affordable.
So the 2H code, that would be the code they would
that's
use.
That's rate of pay. Okay. Yeah, if the employee waives coverage, that would be the code that they. So and this is interesting because in the IRS instructions, they say you don't have to use a safe harbor code, like it's optional. And right from the get-go, honestly, when I was reading the Federal Register, my nighttime reading, I was like, I think you should use this. If you can use a safe harbor code, you probably should use it, because otherwise it will flag the IRS. And we're getting new clients and clients that are getting letters now from 2016 from the IRS, and they didn't use the safe harbor code on the line 16. And so anyway, that's come to fruition. So I always recommend a safe harbor code if you can use it.
So just to clarify, someone asked to repeat.
Yeah.
If you could repeat that again. But what I wanted to, I think it's regarding this code. So when might they want to use that code, and how would they, what code would they use?
Yeah. So there's 3 safe harbor codes specifically for affordability, and they're 2F, 2G, and 2H. The 2F is for the calculation based on the W-2 earnings. 2G is based on the federal poverty level, and 2H is based on the rate of pay. And I recommend that any time an employee has waived coverage and you have offered affordable coverage or affordable premiums based on one of those 3 calculations, I highly recommend using that whichever safe harbor code applies. Now, the IRS has said you can't change codes, like one person can't be a 2F, another 2G. It has to be consistent among categories of employees. But yeah, anytime anybody's waived, I would use the safe harbor code if you can. Does that answer the question?
This question comes in kind of an example. So it says, so if a 60-year-old employee is paying $200 a month, but he earns $2,500 a month, and this is less than the 9.56% of his earnings, the employer is out of compliance for affordability?
No, I don't think so. I mean, that sounds like it would be okay. If he's earning $2,500 a month and it's $200, yeah, that should be all right. But maybe what we could do is come back to some of those calculations and at the end, if that's okay.
Okay. Sure. And I've got just a couple more questions. They're all dealing with this. I think you've hit a kind of a sensitive area for a lot of people. So, so what about variable wage employees, those on commission?
Yeah, so there's different rules for some of those. And honestly, I mean, we only have about 10 minutes, and so it's something that I'm going to get into on the call on Monday. But it gets pretty convoluted, honestly, especially with variable wage. Now, commission especially. If you have a variable wage because of a warehouse kind of job, you would take the lowest wage. Another way to combat a variable wage is to just use W-2 earnings, which is typically the recommendation. But even for employees who get increases in the middle of the year, you still have to use their lowest wage in that calendar year.
Okay. So we have a number of other questions, but I'm going to wait and do the questions at the end for those who only have the half an hour. So we'll give Holly time to get through her discussion and presentation. Then we'll go through all of the questions that everyone's asked here. So Holly, I'll let you go ahead and finish through, and then we'll come back and do questions at the end.
Okay, perfect. Sounds good. The transmittal forms, so this, the 1094C or the 1094B, they're really just cover sheets that go on top of copies of the 1095 forms when you submit them to the IRS. And there have been no changes from last year. So they remain the same. So late filing considerations and penalties, as I mentioned, the IRS is still sending out letters. They're called the 226J letter, and they are assessing both the A and B penalties. The A penalty is if they think you didn't offer minimum value and minimum essential coverage, and the B penalty is if you offered it, but it wasn't affordable. So those are the two penalties, and there's some different amounts that we're going to go over here. So they increase every year. There's it adjusts for inflation. So for this year, for 2018, the adjusted amount for the A penalty, which means the IRS that thinks you didn't offer the right insurance to any of your full-time employees, that's going to be $2,320 per employee minus 30, and that's a whole other calculation, but that's per employee. So if they think that you didn't offer, they just assess it basically on everybody. So we are seeing literally $1 million penalties come through our doors for clients that we're helping. And then if they think you didn't meet affordability criteria, then it's from $3,000 to $3,480 for the year, and that's for the employees that went onto the marketplace and received a premium tax credit. So that's based on a number of employees that received the PTC. Late filing considerations and penalties. A penalty for failure to file correct information is $260 for each return. That's if the IRS sends you a letter say these are wrong and you need to get new ones in by such a date. You just need to make sure you get those in by the date that they set. There is a cap on that. Now, if you yourself, your clients and companies like, oh, we did, something's wrong. And we're seeing a lot of this because people are getting those letters from 2016 and they're realizing that they reported incorrectly. And so now they want to go and do 2017 and correct them. As far as I can tell, I've done some research, but if it's self-discovery, it doesn't look like there's any kind of penalty for that. You just would send in corrected forms. These penalties that they have set, they can be increased if the IRS feels like there was intentional disregard to file the returns and or furnish the required statements to their employees. So HR service, we have a system here that we use, and we are able to gather some information for clients. We are able to create the 1095 and 1094 forms with all the coding. We provide the copies to the employer for distribution to the employees, and then if it's 249 forms and less, we submit those to the IRS on behalf of the company, and then we provide those records to the company for their records. So, okay, so I'm at questions. We have about 5 minutes, it looks like.
Okay. Holly, go to your next screen before I hit the questions. I just want, for anyone who has to leave and can't stay for the questions,
sure. I
did want to say that feel free to drop either of us a note or a call if you do want help with, for you or any of your clients in doing the ACA reporting. We're filling up quick. And so we're trying to, if you want somebody, you want to make sure it's done on time, do get hold of us soon. So you can send that over to me, Ken at hrservicing.com, or Holly, or give either of us a call at those toll-free numbers that are shown. But let's go. So you can go ahead and leave that there, Holly, and I'll go over to the questions now. So
sure.
We'll send out the invite again for anyone who would like to join the Monday session. Where Holly's going to go into much more detail on some of these. But we will go ahead and answer these questions now. So the first question is, let's see here. Okay. And follow up to your question, what if they know everyone is working 40 hours? Can they use a larger number rather than 130?
No, the IRS requires the 130 hours.
Okay. We had a client that filled their forms out on time, but some of the safe harbor codes were incorrect, and they received a hefty fine, $350,000 plus. Should they have received good faith penalty relief?
No. So really how this was set up initially is if you put I'm just throw something out there, a 1E code and it should have been a 1A code, just because that code was wrong, they would assess, a penalty for that mistake. And if the Social Security number was wrong, they would assess a penalty for that mistake. In addition, they would still have the A and B penalties. So they're not penalizing on the actual mistake, but they are taking the information, and because there have been mistakes, they are just making assumptions that, it wasn't affordable or it wasn't the right kind of offer. And so the A and B penalties still exist. So I think that answers that question.
Okay. So if we had Kaiser Insurance January 2018 through October 2018, but we changed to a self-funded plan, like say Cigna, November through December 2018, do we fill out the forms any differently?
Yes. So, and it depends on if you're an applicable large employer. So if you were a small employer and that was the situation, you would only need B forms from November or for November and December. However, if you are an applicable large employer, the only difference would be Part 3 of the 1095-C form would need to list the employee and any of their dependents for the coverage that they had in November and December.
Okay, thank you. Let's see, is it affordable for all the employees? Let's see, make sure I'm reading this right. If it's affordable for all the employees but doesn't fit into the safe harbor and the employee declines, what code gets used?
So it's, well, we have to use the affordability calculation that the IRS gives us. So if it doesn't meet within the parameters that the IRS provides, and so it's not affordable according to their standards, and they waive it, then line 16 would be blank. And you would just, that potentially could send up a red flag to the IRS, but that would be, ultimately, that could potentially be a B penalty, and it would just be that employee or those employees who went to the marketplace, who waived, went to the marketplace and received a premium tax credit. And it's my experience for all three of those things to happen is pretty unlikely.
Okay. So why do they need to? Why should employers do safe harbor calculations? Because there is an option where they could try and do the whole household income, but that's
well, so well, and there's tons of stuff in the Federal Register, and that very thing was brought up and argued about the household. So just because an employee went to the marketplace and received a premium tax credit, they may be well entitled to it because they have 10 people living in their house or whatever. You as the employer, you have no, you may not know what the situation is, and you don't need to know the situation. So it really kind of all comes back to making the employee only coverage premium, the lowest employee only coverage premium, affordable for the employee. So that's what the IRS, that's what they settled on. Does that answer that?
Thank you. So the question is asked, if we provide you the data now, submitted everything, could HR Service generate the forms on time? And if so, what would the cost be?
Do you want to take that, Ken, or do you want me to take? Well, I guess I'll talk to timeliness.
Yeah, go ahead.
So we have been asking most of our clients to get their data into us. We've thrown out a date of Monday, the 21st. And part of that is because if we can finish those, and we are in the process of finishing several reporting accounts, we could probably, it's likely we can get this done on time, but we would need to make sure that everybody is very responsive. So I guess that's a kind of a double edge. If we get the information by the first week of February, we'd probably be okay, as long as the contact that we have with the client, they're very responsive to us in getting the things that we need in a timely manner. We're going to do everything we can do to meet the deadlines. So I hope that's helpful.
Yeah. So just to kind of summarize on that, I mean, the quicker that someone can get in their forms and information, get signed up with us, the better. And then we do need them to be very responsive so we can meet the timelines. Cost-wise for us, for the C forms, so that's anyone who's an applicable large employer, they're going to be anywhere from $1,800 to $2,000. There's some other factors that might add in a little more cost, like if they're having to submit to the IRS or having us do forms or age banded, multiple EIN, some of that other stuff. But if you get hold of us, we'll get you some details on all the pricing and give you a proposal for any of your clients on that. Next question is there any time dependents are required to receive a separate 1095 form from the employee?
Oh, from the employer? Sometimes for self-funded groups, if somebody went on COBRA, so the situation that first comes to mind is an employee retires and gets divorced, and the employee chooses not to do COBRA, but they had their spouse on there, so the spouse is also offered COBRA. You may have to, and this is just self-funded, and it would just be a B form. Even if you are an applicable large employer, you would send that spouse a B form. And the reason you want to do that is because employees need the forms. They don't have to send them into the IRS, But if they ever get audited, they need those forms to show that, yes, I did have health coverage on, these months, January through October, or whatever that looks like. So it doesn't happen often. Like, I think it's in 3 years, I think it's happened maybe once. But yeah, that would be the situation where that would happen.
Okay, so along with the same question, they made the comment, so one form per family listing all covered dependents would suffice.
Yes. Correct? Yep.
Okay.
Yep.
Do these rules apply to all group sizes?
No. So for small groups with 50 or less employees, and that's a calculation that's done on a 12-month period the year before. There's no coding. There's no 1095-C. There's no pay or play. There's none of that. None of those rules. So the reason that self-funded groups have to do the B forms is because essentially the company is now like an insurance company. So a fully funded group, the B forms come from the insurance company. So sometimes you'll hear, well, we already got a form. And so they're getting the B forms from the insurance company, which is their portion to show that they had coverage for whatever months that they had coverage. And the C forms are really about showing the IRS that the employer is doing everything that they're supposed to do. And just by chance, and just because they have to send a copy to the employee as well. But the C form to the employee, unless you're self-funded, really, like, they don't know what that is. It really, honestly, it doesn't apply to them other than tell them that, yeah, my company did what they were supposed to do.
So if the employer was found to not have not offered affordable coverage for a single employee who received the PRC, but affordable coverage was offered to everyone else, and the minimum essential coverage was offered to everyone, does the employer pay the $3,000 plus penalty for that single person?
Yes. Yes, if they get the letter. So there's other steps that would, generate the letter, but if they get the letter and it really came about because it was unaffordable, and that's why that person went to the marketplace, then yeah, they would be on the hook for the the $3,000 plus for that employee.
So they may not even get a letter if no one
right,
goes
and if they
subsidy and they're not triggered
right.
flagged.
Right. Yeah.
Okay. Is it affordable as if it's less than 9.56, but is not based on on one of the safe harbors?
No, it has to be one of the three.
Okay, and then there was a comment, I think we might have covered this already. They said, can you address applicability for both under 50 employers and over 50? So I'm going to mention, so anyone who has had 50 or more during last year, so in 2017, they would be called applicable large employers. And those are the ones who have to do the 1095-C and 1094-C documents. Anyone who's smaller than that, they don't have to do anything unless they offer a self-funded plan. And then, as Holly mentioned, then they do the 1095-B and 1094-B documents. Let's see, we've had one other question that came in here. Is Medicaid slash cover? Oh, let's see. Is Medicaid coverage considered the same as PIC or PTC?
So PTC, no. So Medicaid, if anybody's on Medicaid and Medicare, they should be getting 1095-A forms, which from everything I can tell is kind of equivalent to 1095-B, and be able to show the employee that they had coverage, so that when they do their 1040 forms, they can, honestly say, yes, I had health coverage all year or not. So that's not, that doesn't have anything to do with a premium tax credit, no relation.
Okay. Thank you. Well, that's all the questions that we have in now. I wanted to thank everyone for joining us and participating. And thank you, Holly, for the wonderful presentation. And as mentioned earlier, we are doing a more detailed presentation on Monday, this coming Monday at 11 a.m. Mountain Time. And so we will resend out that invitation to anyone who participated here today. Feel free to invite your employers to that one. We can take as many individuals as possible, and feel free to invite them to help them to be informed on this. If we can help you or any of your groups in getting the documents complete, get hold of us soon, because we are filling up quickly, but we do still have space. And you can drop me a note, ken@hrserviceinc.com, or call at that 855-447-3375 extension 6, and I can help you get that started. I'll connect you up with one of our compliance individuals and we get that whole process started. Again, thank you. Thanks everyone for participating. Thank you, Holly.
Yeah, thank you. Have a good afternoon.